So my name is Frank Brannvoll, and I used to be heading quite a few trading organizations, but I got independent, so now my job title is actually founder and director for my own company, which is called Brannvoll ApS, which now is situated in Denmark, after having 23 years in Belgium and Switzerland abroad. I'm also the editor for this magazine called SEM Review, which you're seeing here. And the most important thing that we tell our readers is actually that you need to look at everything in a context. You start with a dollar. The dollar is a kind of the mother of all commodities. With a weak dollar, a commodity tends to go more expensive. With a more cheap dollar, a commodity tends to go more stronger in that respect. So therefore, we always start by saying, what do we think about the dollar against the euro, and also the dollar against the major currencies like the Turkish lira, which we could talk about coal, or we talk about petcoke, and for other ones like the Indian rupee, and of course the Chinese renminbi. And what we have seen lately is that the dollar has broken out of a range which was 105, 115 to the euro, and we had a prediction of about 125, which we hit. Then we have seen a lot of turbulence lately, both geopolitical, which tends to strengthen the dollar, but also we have seen Italy election results. We have seen Germany with some unusual, you can say, instability within the government in Germany, which have all gone a little bit against the euro. At the same time, so we have seen a strengthening of the dollar coming back to a level about 115, which we definitely now think is the support zone for the euro. And from here, we see a weaker dollar over the next, I would say, 14 months, and I will see it coming up towards 120, 125, and I have some long-term predictions that we are going to see a repetition of what happened back in 2002 to 2003, where the dollar actually fall quite dramatically. And don't forget, the first thing Trump said when he was elected as a president, I do not want a strong dollar. So the policy from the US will not be to support the dollar in the contrast. Of course, then there are something called interest differentials that US will take rates up, but so will Europe. And when that happens, I believe in a weaker dollar. So 125, 130 for the euro against the dollar over 2019 is the prediction. When you talk about energy, the mother of all energies, to mention the wording of an old dictator, is actually oil. And without the oil, you can't really predict any of the other things. So that goes into gas, it goes into coal, it goes into all kinds of derivatives of the energy part. The oil market has been trading normally, and I don't know if you can see it, it trades in a kind of a very big trend coming down, and within that trend you have a kind of a snake where the price can go up and down, but all the way inside the trend. We had a steep downtrend from 140 going all the way down in 2016 to around $30 per barrel of Brent oil. What happened there was OPEC and Russia and some other countries, non-OPEC countries, went together and make a kind of a production agreement. That made a kind of a turning point. And when you look at pictures both for coal, for oil, and many other energy sources, the bottom line is always from there, and then we have seen a trend line going up like this. That trend line has been one steady trend channel where we have seen the price within it go to the top, to the bottom, but all the way keeping within this trend line. A very significant area is $80 for Brent oil. And that was actually broken not too long ago. And we have been predicting in the SEM review, my commercial hat on, that if it breaks 80, we could easily see a jump towards 100, even maybe $110. And I'm not talking about Saudi Arabia like last night threatening the US against turning down the barrels. We simply talk about on the 4th of November, the US sanctions against Iran is going to take away the Iran production. Not that they don't want to produce, but nobody wants to buy from them. So in that respect, we can say that will almost flow out of the market. Venezuela, I'm very sad to see what that happens there, but they don't produce anything, or they produce, but it's like 10, 20% of normal production. So at the moment, the oil market is very, very tight. And as we have broken 80, you have seen a very big scrambling after the market, came up to 87, and now bouncing back to 80. I think we're going to see around 70 to $100 for oil. It may peak higher if some geopolitical things are happening. As long as we are at 70, that's the bottom of this uptrend channel. And the 100 is actually the top where we are looking for that now. That is driving all the other energy commodities, including coal. And I showed in my presentation that you can actually see that when you have the downtrend in oil, you have it in coal. When you have the flat in oil, you have it in coal. etc., etc. Not dollar per dollar, but the trend. The trend lines in coal, and it doesn't matter if we talk about API 2, which we discussed in here, which is delivered into Europe, or we talk about API 4, which is just another grade, free on board from South Africa. It has exactly the same trend lines. And again, starting from spring 2016, we have an uptrend channel. Within that channel, it has been going up and down nicely, just like oil. It has broken some levels where oil broke 80, coal has broken about 95. When that happened, it sent a kind of, you can say, a technical target for the market going towards 120, which happened also to be the heights back in 2012-13. So again, the market repeats itself. That happens in many markets. And in that respect, I do think we can actually see some peaks going up to 120. What I'm predicting is a trading range of about $30. You may say, wow, that's a big trading range. Yes, we traded actually $29 last year. And in the more short-term coal, we have been trading $35, $40 in trading range. So it's not so unusual. Volatility is here to stay. I'm saying that we will see within the channel, as long as 19 is kept on coal, we are on the upside. And the forecast is for coal API 2, which is delivered in Europe, 90 as a bottom, may peak to 120, as an average for the quarterly, 110. And actually, we have exactly the same trading range for the calendar year, which means what can you in 2020 by 2024? So what can you in 2019 by 2024, the next calendar year? I enjoyed speaking here. I think it's fun to give, beside all the people who are much more clever than I, that have all the fundamentals part, to give a little bit more simplified way of maybe looking at the things. There's a lot of work underlying that, and I like to put that out. As I have gone independent now in this respect, I'm of course also trying to promote my part of the business or finding business partners to do. So I think it's a great event. The only thing I'm sorry is to say that we saw these people this morning, which is actually, and I like actually to say this, are demonstrating, first of all, the wrong place. Because if Europe shut down our coal consumption totally tomorrow, we would probably, with a little luck, save about 10 days of Chinese consumption. And if we add India on top of that, Europe totally flattening out coal consumption would be 7 days that we would save the environment for. Not that it's not good, but it just shows maybe this is not the right place to actually to do the demonstration in that respect.